Today I want to talk about what you need to know with regards to the use of your CPF contribution as a way to lower your taxable income. In total, there are three types of voluntary CPF contribution that is available to you today. Voluntary contribution in this case means a direct cash deposits into your CPF account. Okay? The first is to do a deposit into all three accounts, which include your ordinary, Medisave, as well as special account, of which you have no control over how much goes into what account. The second is to do a deposit into your Medisave account only, while the third is to do a deposit into your special or retirement account only via this thing called the retirement topping up scheme. Please take note that you will not be able to reduce any taxable income for voluntary contribution into all three accounts. That is only applicable if you do a direct contribution into either your Medisave or your special or retirement account only. With regards to the yearly taxable income reduction limits, do take note that for direct cash deposits into your Medisave, the limit is basically the difference between your annual CPF contribution limit and the mandatory CPF contribution, which includes your contribution, which is the 20%, as well as your employer's contribution, which is another 17% of your income. Okay? The annual CPF contribution limit as of 2021 stands at $37,740 $740 a year. For direct cash deposits into your special or retirement account via the retirement topping up scheme, the taxable income reduction limit is only 7K for your self-contribution and another 7K for contributions to your dependents account, which adds up to be $14,000 in reduction of your taxable income a year. Dependents in this case refers to your parents, your parents-in-law, your grandparents, grandparents-in-law, spouse, as well as your siblings. Now, when it comes to the pros and cons of doing CPF contribution, the pros is of course you gain a higher guaranteed interest return of 4% per annum for your special as well as your Medisave account, right? And these returns that you're receiving are effortless while saving on taxes, right? The cons of doing CPF contribution is of course these contributions are irreversible, right? And once you contribute into your CPF, be it special account or Medisave account, you are unable to withdraw your CPF balances until the age of 55 and provided that you are able to meet the full retirement sum. Personally, I prefer the use of CPF as I treat it to be my long-term savings account or like a bond, right? The reason why I have a preference over CPF is because number one, it is risk-free return, right? Number two, the returns are 4% for special account, Medisave account, and 2.5% for ordinary account, both of which are very hard to come by in a low interest rate environment, even for your long-term savings plans like your endowments or your fixed deposit. Third thing is I get to save on taxes while earning a higher effortless return, right? Compare that with the use of endowments. It is actually quite concerning to me that a lot of people or even insurance agents have a preference towards saving in long-term endowments with similar levels of illiquidity, right? Because you're taking on higher risk as compared to parking your savings in CPF. You're getting lower returns, both in guaranteed and non-guaranteed sense, and there's no tax savings, right? Sure, you might be able to get higher flexibility in between, but do you really need this flexibility is another question, right? So it doesn't make sense for me to save via endowments because in terms of the internal rate of return that's adjusted for risk, CPF contribution definitely yield a higher risk adjusted return than your traditional endowments itself. Now, a word of caution though, while the use of CPF as a tax saving instrument is preferred, it is important for you to consider how this will affect your overall cash flow and liquidity needs, and you need to plan it alongside with your other areas of your financial plan. Specifically, so plan it with accordance of your retirement planning because, like it or not, CPF plays an important role when it comes to your own retirement. Okay? If you know how to use it well, CPF can be a very formidable and competitive instrument that will help you accelerate your retirement planning. But if you screw it up and if you don't know how to use it well, Blindly contributing into your CPF can cause you to have short-term liquidity issues that may jeopardize your long-term performances. So please plan properly and look at your financial plans as a whole, right? Look at it more holistically and see how your decisions in one area will affect the other areas of a financial plan, right? So that's all I have for the video today. If you'd like to find out more about how you can benefit by working with an independent financial advisor and a certified financial planner, you can reach out to me via my website. Do follow me on the following social media platform as well to stay connected with future content, and you can always slide into my DMs anytime when you have any questions. I'll be happy to help. Now, all these links that you see on the screen will be in the description below, so stay safe and I hope to connect with you all soon.